Okay, well, Matthew, you reminded me to invite you to introduce everybody for those who are not known to each other. So would you like to do that first?
Yeah, thank you very much, Ray. Yeah, just for committee, just to ensure that you're aware of everyone on the call. Obviously, we've got Julie West from Hymans, the fund's actuary today. I'm sure Julie will be partaking as we move through parts of the agenda, especially around the funding level. We're awaiting John Arthur, your independent advisor. Hopefully you all know well John on that side. I'd like to welcome Daniel and Karen from Aon today. They are here to actually observe the meeting predominantly today. They will also be doing the same for the Pensions Board meeting on Tuesday. And this is part of the overall governance review, which we've commissioned Aon to undertake to help us. And what they will do is obviously not talk at this stage, but at the end of the meeting, when we come to that item towards the end in the exempt session, they will give an overview of the scope of the review and how members can actually help and frame that review and help us support that through. So just to really make sure committee are aware of why Daniel and Karen are here today, just to as part of that review to observe the interactions of committee on that side. So back to yourself, Chair.
Okay, thank you. Well, before I go on, I'd just like to say this is the last pension committee of this particular term of the administration. And I'd just like to thank everybody who's participated, I think with great goodwill, in the last 4 years. And we've managed to keep politics out of it to the greatest extent, which I think is right, because our main concern is, of course, for our pensioners. So thank you for that. And on the whole, it's been, I think, a very good-humoured group of people. And thank you so much for that. Later on, when I come to chair the County Council meeting, I'll be bidding you farewell, but I won't do that now, as we might see each other again later on. But I just wanted to thank everybody. We are missing somebody, aren't we? Are we? Sorry, yes, Lyndon.
Yeah, Chairman, I think I'm sure that all of the members of the committee would, at this point in time, wish to place on record our thanks for your chairmanship for quite a few years. I think your chairmanship predates the membership of all the members on the committee. Maybe I don't know. Maybe Sean, I don't know. But I think, having worked with you on this committee, you've done an absolutely wonderful job of chairing it. But I think it's the work that you do in the background that we don't see, which is the work that has really helped put this committee into a much better position we were than certainly when about 10, 12 years ago when I first joined it. And indeed, the work you've done as a member of the overview board on Brunel and indeed chairing of that board, I think is very much testament to your own personal skill set and knowledge base that you've brought to this committee. I mean, you are going to be an incredibly tough act to follow, Chairman, on this, because you come from a background which has given us all a huge amount of input and knowledge, and we're most grateful for it. And I'm sure we all wish you well. But it's absolutely right, I think, that in this public part of the meeting, we place on record our thanks for the work that you've done, the absolute dedication to this committee you've expressed over the last few years. Thank you, Chairman.
Thank you very much, Lyndon. I'm tempted to send you a bill, but let's leave that for some other time. But thank you very much for those very kind words.
I'd like to add to that too. I'm not going to re-say what Lyndon's just said, but I think that the skill is shown, in fact, in the very good situation where the pension fund now is. Though I can't remember what the deficit was when you first arrived, Ray, but the fact that the last figures I saw that we were not quite in surplus, but certainly break even or roundabout break even with the deficit removed is well, it speaks for itself. So thank you very much.
Thank you, Sean. Yes, I remember when I was trying to remember the lowest level that the pension fund has been. And I seem to remember, I don't suppose anybody else can, that we once had £750 million And I'm rather horrified to see we have now something like 2.5 billion. Now, I can't claim all the credit for that, Sean, but perhaps I'll leave something on the plate for other people. But yes, it is quite amazing how it has grown. And you mustn't say too loudly in Lyndon's presence, but we are now in technical surplus, and he might want to snatch that for his for other use in the council. But yes, we are in I think a relatively good shape. Yes, Colin.
I can't let this pass really, and you know, from the opposition, as it were, not that as you say, we've kept politics or tried to keep politics out of it. I may have slipped in the odd word from time to time, but it's a great committee to be on, and that is it's an interesting committee, which I keep telling my colleagues and they don't believe me, but it is, and it's helped by good chairmanship. So I do appreciate your chairing skills on this committee.
Thank you, Colin. Yes, I think that we've all benefited by having something really rather meaty to look at, other than the normal froth of political toing and froing. And I think it is very important to know that we have been working, I think, for something like, according to our annual report, something like 50,000 pensioners now. Is that right, Matthew? Perhaps you haven't caught up with that. But there are a lot of people who are behind the scenes in this, and so yes, we have been conscious, I think, all of us, of that responsibility. Hello, John, you're here.
Yes, Mark.
We're just passing around the hat with accolades and things, John. So you haven't missed much. So welcome. But thank you very much, Colin. Can we move on now to the agenda? Apologies, Andy. Do we have any apologies?
We do. We have apologies from Councillor Rachel Smith, and Councillor Nigel Moore, as a member of the Pension Board, has tendered his apologies for this morning.
So Nigel won't be appearing at all?
No.
Right. Okay. Good. Thank you. Declarations of interest. Members, any declarations of interest? Right. Public questions. I think we have a question, Andy.
We do. We have a member a public question which has been submitted. The response has been circulated to members of the committee for information, and I'll hand over to Matthew at this point to read the question and the response, please, for the public record.
Okay, thank you very much, Andy. And yeah, committee, bear with me while I read what was provided. So the question that was received was, what steps are the committee taking to persuade the Brunel Pension Partnership to divest of its remaining 2.9% investment in fossil fuel related assets? The response provided was as follows. The Gloucestershire Pension Fund aims to deliver strong investment returns over the long term, protecting our interests through contributing to a more sustainable and resilient financial system, which supports sustainable economic growth and a thriving society. The Brunel Pension Partnership manage the investment of the assets of the Gloucestershire Pension Fund in conjunction with 9 other funds in the southwest of England. As such, Brunel will own and maintain a responsible investment and stewardship policy on behalf of their clients. The current Brunel policy on engagement and divestment states, on the issue of divestment, Brunel supports divestment from specific fossil fuel and other carbon-intense companies if they present a material investment risk, such as due to stranded assets. But this is based on analysis by our asset managers. Brunel expects managers to take these decisions independently. In addition, we have committed to review this approach and indeed the holdings themselves, and to evaluate whether companies are taking steps to manage climate risks and to enable our overall alignment with the Paris Agreement. Brunel set out clear expectations for its asset managers and a deadline of 2022 for reviewing companies. Our climate stock take is due in 2022. The criteria to evaluate companies and managers is being developed with our clients. It will take into account different investment mandates and starting points, but always with reference to Paris alignment. We choose not to use exclusions lists with our active managers. Instead, we require them to analyse the companies and other entities they invest in, and to justify their investments in those companies with higher greenhouse gas emissions. We do not currently issue exclusions lists because what is most needed is change in the way investment managers work. Simply enforcing exclusions or requiring divestment from specific stocks or sectors will not compel investment managers to develop their capacity on climate change or to drive change in the companies they hold. Climate then becomes a technical, operational matter, not an investment priority. However, we acknowledge that we may need to take other action and have reserved the right to implement specific and stock-specific exclusions as part of our climate stocktake in 2022. The fund supports this policy and looks forward to working in collaboration with the 9 other funds and Bruno on the outcomes of the climate stocktake in 2022. Thank you.
The questioner was Chloe. I can't remember the name. Chloe.
Sorry, Chloe Horner, I believe.
Is Chloe Horner with us today, Andy?
No, she isn't. I sent her the response the other day as per members, and Chloe was happy with that response.
There's no supplementary question then, so we can
There is.
move on.
Yes, we
Are
can.
there any other questions?
No other questions received.
Right, so we can then move on to members' questions. Are there any members' questions?
No members' questions received either.
Then we can move on to the minutes of the meeting held on the 29th of January, which is on pages 1 to 4 of the papers. Has anybody any comments, criticisms, complaints, grammatical input? If not, can we take those as approved? And we will find a way of signing off on those in due course, Andy, is that right?
We will, yes. I'll note for the record they've been approved. Thank you.
We now move to item 6, which is on pages 5 to 24 of the papers, which is a paper by Matthew, the Pension Fund Quarterly Update. Matthew, I think we can take it that members will have read your report, so perhaps you could summarise it, and then we can invite questions. Thank you, Matthew. Over to you, Matthew.
Thank you very much, Ray. So the Gloucestershire Pension Fund Update Part 1, as Ray has pointed out, it starts on page 5 and the covering report runs through to page 14. There are a number of more detailed appendices if members wish to kind of dive a little bit more into the detail. The report in Part 1, realistically, the recommendation is that the committee notes the position of the fund as at the end of the quarter, 31st of December 2022. So we'll go through parts of that, and I will invite certainly Julie and potentially John to interact with committee on certainly some of those points. So this is a backward look at where the fund position is at that point in time. Within the agenda today, we have got a part 2 where we will potentially dive a little bit more into some of the activity that's taking place currently with regard to the investments and a little bit more granular detail on those investments. But this will give you the broad outlook of where we are. So in terms of the investments over the quarter to the end of December, I'm pleased to say that it was another good quarter for the fund, increasing by 7.2%, and that was ahead of its benchmark, which ultimately meant an increase in the valuation of £193 million during that period of quarter. That takes us back to the pre-COVID levels. So the adjustment that took place at the beginning of the pandemic, which is now, I understand from my wife today, I've been at home for 51 weeks now, so coming up to a year of the pandemic on that side. Page 15, the appendix 1 has the full performance numbers for committee there. But the year 1 number for the entire year, up to the 31st of December, the fund returns 7.8%, which was ahead of its benchmark. And over a 3-year trajectory has returned 5.9, which is slightly below the benchmark, but is still in excess of the desired return that the actuary is seeking during that part. What I've also included at Appendix 2 on page 17 of your papers is the current strategic asset allocation of the fund as at the end of December. Now, we will recall that the committee met in January and agreed a new strategy for the equities. That is not reflected in those numbers. And in part 2, I will provide more details that are going on with regard to the transition to the new equity structure. But for committee, in that appendix on page 17, you'll be able to see the position of the portfolio, and certainly in the ambers where the actual strategic asset allocation is outside of its target range. So as you can see, global high alpha, which we'll discuss a little bit further later, is one that really does stand out as being 6.4% over its allocation weight on that side. If we go back to page 6 of your report, it just gives you a highlight of the investment activity that's taken place in the quarter to December. There was a rebalance. The investment of 50 million and a commitment of 50 million to international property was made to Brunel as per the committee's decision with regard to that. So that commitment was made. And at that point, an additional 14 million was made available to UK property to help rebalance the UK property portfolio back to its target level as it was approaching just falling out of its range at that particular point in time. For committee's information on page 7 and 8, I've taken a snapshot of the activity, which I'm not sure if committee had seen before. Hermes, EOS, not the Hermes property mandate, which I know that the committee are well aware of, but Hermes EOS are appointed by Brunel as the partnership to engage and apply the voting and engagement strategy of Brunel. And they do this for multiple asset managers. So they are talking on behalf of asset managers for multi-billion pounds worth of activity. Bearing in mind the questions that were raised by the public on this, what this actually gives is a snapshot of the activity that is being undertaken on behalf of the fund, which is around our active ownership of the stocks and shares that we actually have. So on page 7 and 8 gives an overview of the voting statistics. And on, I think more importantly, page 9 and 10 gives an overview of the engagement that Hermes EOS has actually undertaken with companies on our behalf and on Brunel's behalf and in accordance with the policies that are in place. So as you can see, they've engaged with 368 companies in the quarter over a range of issues, totaling over a range of over 1,000 issues on ESG related matters with those companies. So that's going to get an overview of where we are on that activity. Moving on to the funding position, and I know we briefly spoke about that just a moment ago, and I am pleased, and I will hand over to Julie to look at that. But the latest funding position provided by Hymans on a rolled forward basis from the valuation is putting the fund in a very healthy position at about just under 107% funded at this point in time. Julie is on the line, and I'll invite Julie just to talk to committee with regard to the position on the funding, and I'll refer you to Appendix 3 on page 19, which is Julie's covering report. So, Julie, I don't know if you would like to come in now.
Sure. Morning, everybody.
Morning, Julie.
Yeah, as Matthew said, we've carried out a funding position calculation at the end of December. The funding position has improved from the formal valuation, so liabilities have grown, as we would always expect with the accrual of new benefits, but assets have grown by a greater amount. So the return over the period since the last formal valuation, it's been 16.6%, so well in excess of what we had assumed for the purposes of reporting that position. It's worth bearing in mind that, as Matthew mentioned, this is very much a snapshot in time and a backward-looking position. So all we're considering here is what has happened to date. We are approaching a year off next year's formal valuation, when we'll be looking at contribution rates and the long-term expectations for what assets might do. Those are the factors that are much more likely to feed into what will happen with contribution rates. When we set contribution rates last time round, we do have an element in there of outperformance. So we allow for asset returns in excess of what we do for reporting purposes when we're assessing that contribution rate. So it's a bit early to say how things might look in a year's time when we're setting contribution rates, but certainly from a backwards looking perspective, the fund is looking in a healthy and well position.
Thank you, Julie. Now, Matthew, have you finished your? Have you got anything more to add?
I've got a little bit more to add, and then I'll hand back. So I've got about another minute or so, if I can, just to follow on from Julie's point. So I'll refer the committee to page 12, just an update on the fund administration on that side. And at the top of page 12, the first table. So can advise, obviously, despite the COVID impact and an impact on working practices, the administration team are still performing well during that period of time in terms of the targets. What we have seen in table 2 on that page is a slight reduction in certainly some of the activities that we would normally have seen in terms of number of estimates and number of leavers, as obviously staff turnover has been slightly lower during this period of that pandemic. And certainly normally where organisations might have been looking at certain restructures that would generate that kind of activity, those have obviously been placed on hold in predominantly in some of those areas. I think what we will see as we do see a return to formal normality is that levels of activity picking back up again across the team as we go through the next 12 months. And I think page 14, I'll just refer, and a bit of an update really for committee. And I know we've talked about before, and committee might well have been aware of one of the regulations that was taking a long time for government to get in place, which was the 95k cap. If you remember, what this was a desire by government to have a cap on the exit payment or a payment to an individual on the point of redundancy or efficiency grounds when they actually left a local authority, to be capped at 95,000 across all public services. It had taken a number of years for us to get to the point of regulation, and the regulations survived about 3 months and have now been revoked currently by Her Majesty's Treasury. They were going to be placed under judicial review, and I think there was actions on that side. And I think from what I understand from the government's perspective, I think they felt that they were unlikely to be successful with that, so therefore they have revoked those regulations at this point in time. However, I think government have made it clear that they are now reviewing those regulations and will come back during the summer with new regulation, either via consultation or just new regulations in regard to this, because they still have that appetite to put a cap on those exit payments moving forward. So I think we're in a bit of a stay of execution from that. It has meant that we've had to redo some of the activity from the administrative side on that side, but it hasn't been too onerous. But obviously what we don't know is what we don't know what the new regulations will look like. So just an update for committee on the 95k cap regulation situation as it stands at this point. So on that note, I think the recommendations on page 14, and I'll hand back to yourself, Chair. Thank you.
Right, thank you, Matthew. Members, have you got any questions? Is that Lyndon? Are you signaling?
Yeah, can I just, it's on page 21, so it's part of the Hyman's report. Couple of questions. On the funding level chart, is it the case that you've retrospectively come up with some of those figures by applying the new criteria? I'm looking particularly around the funding level March 19 to December 19. I don't think those are the figures that we were reported on at that time. So is that just a retrospective restating of the funding level. That's the one question. And on the cash flows one at the bottom, does that indicate cash flow going out, or does that indicate the net cash flow requirement?
Cash flows going out. So
in other words,
that's the projection of the benefits that we expect the fund to pay. Yeah. And in effect, the liabilities that we report are placing a single value on all of those future cash flows. And so that chart at the top will be what that value was at that date, and an allowance for what we estimated the assets to be at that date. So that the funding level chart is taken from your valuation results. So it should be consistent with what you've seen before. So valuation results allowing for that to be projected over time.
Yeah, I guess what it's saying is that in March 19, as far as I remember, we weren't being told we got 105% funding level at that point.
So
I thought the review was after that. Well,
it may have been. So if we had reported these figures at March 19 prior to the formal valuation being carried out, then they would have been based on the previous valuation. So there's almost a rebasing.
Yeah.
So we recalculate everything at a formal valuation and then start again.
Okay, I got you. Thank you.
So just to be clear about that, having regard to all our liabilities, we are solvent.
Yes.
Good. That's as a former banker, I'm glad to hear that we're solvent. Thank you. Thank you, Julie, for that reassurance. Colin, were you waving, or was it just live? Right, okay. Anybody else? Any questions? Yes, Andy?
David Gray's waiting to ask a question. He's got his hand.
Oh, David, sorry, didn't see that.
Followed by Peter Clark.
Right, David, first.
Thank you. My question relates to what does engage mean? On page 9, when we're talking about issues on which, on our behalf, the body responsible for engagement with companies, what does engaged actually mean in that context? Is that's not voting per se, it's direct communication with the underlying companies. Is that my understanding?
That is correct, yes. So that's direct communication with members of the board, the senior management team, discussions, followed up with correspondence. So it's that level of engagement. It's not voting at an AGM. This is activity outside of the AGM, in terms of influencing and working with those companies.
Okay.
John, have you got anything? John Arthur, have you got anything to add to that? Is that? I think that we do that a bit in a modest degree ourselves, don't we, as well?
Yes, so I think the way to look at it is it's more than just meeting the management for an update on current progression. It would be a meeting with an agenda, including areas of concern, and attended by senior management of the company, and followed up with an email trail. So there should be an audit trail for each of those meetings.
And so that's interesting, the sort of distribution of what we engaged on, and presumably, depending on the results of that engagement, you then go to page 8, which is the actual voting, how we've voted, or how our holdings have been voted. And I notice there's maybe I'm misunderstanding the information presented on page 8. Is my understanding right that quite often we're voting against? It has things like board structure and remuneration. Are we voting against proposals that are being put at AGMs? Is that what's been captured on page 8, or is it just capturing the issues that we're voting on?
Yes, John.
That will be the information in there will align and actually give you information about where they voted against recommendations and motions by the board, and predominantly some of that will be board composition, reappointments, and remuneration policies in accordance with the policies that's in place.
I'm looking there. The two that spring out is we're often voting against remuneration and board structure just based on the number of times. With 96, for example, global 96 resolutions over the quarter. We voted of the split where we voted against. 96 seems quite a reasonable number that we voted against. But obviously you don't know the context of that. Is that a 96? There are 20,000 resolutions we voted against 96, or is it there are 200 resolutions we voted against 96? So it's difficult to judge how actively, if you like, we're voting against because there's no context on what 96 of how many, if you see what I mean. And then the ones that turn up frequently are board structure and remuneration. So I'd like to understand, what is it that we're taking exception to on board structure and remuneration? What are those issues on board structure and remuneration?
Arthur, could you answer that?
I'm happy to have a pitch at it. I think quite often it'll be the age-old one of a combined chairman and chief executive role, or a lack of independence in the independent directors. And in remuneration, it'll be a warning shot that it may well be a share option scheme or award of share options that's the issue.
And do we have a sense of where this is going? Is our level of activity, because this is obviously a snapshot of over this period, but do we know whether we're getting more active or less active, or these issues are becoming, if you like, more contentious? We're voting against boards more frequently?
I would say that the industry in general, the asset owners are more often voting against boards in terms of structure and remuneration. I don't think that should come as a huge surprise. We're seeing greater wealth disparity than we've ever seen before. So, and I think the most obvious recent one would be Rio Tinto, where the chief executive had just been forced to resign. And this follows in the company blowing up a couple of Aboriginal historic sites of thousands and thousands of years old. And it came to a head when he also received a 20% pay rise over that year. And so it is issues like that. I think it's a feeling that some executive remuneration has got out of touch with the effort and risk they're actually taking within that. So there's an increased pressure to want value for money, I suppose, out of executives. I think with board structure, it's to force an independent voice onto that board. Particularly in less developed markets, that's very relevant.
Because so all of which I understand. So I just think it might be for us as a board or oversight body, for us to have a engagement about the underlying issues. Like what is the position of the fund in terms of some of those issues, and almost a qualitative discussion about what are the issues that we're seeing and where does the fund want to be on some of those issues, if you see what I mean. Because at the moment it's just it's who's deciding whether we want to take a stand on what we really want to pursue as our position in terms of using, with 2.8 billion pounds under management, we have a certain sway and I think it's important that we're all clear how that's being used.
Yeah, I think that's a fair comment, David. I think what we should do, Matthew, is feed that back to Brunel and say we'd like to have a bit more substance around these numbers. And I too somewhat confused about what these percentages are supposed to be. And so some clarity, some further explanation, not pages and pages of it, but on a single page, please. Just how do we get to these numbers, and what are they mostly about, and the extent to which members such as ourselves may have some input from time to time, because I think there are some companies which are in our area, which is broadly speaking Southwest, where we all might have all members may have something particular to say. I don't know. I mean, but it did happen. I know when we were independent, there were one or two cases where we took an interest, but on the whole, we didn't. We left it to the managers. But if it was if there was a local interest, we certainly did. So Matthew, can you take that back and have a little chat to Brunel and see if we can get some more, perhaps you might, without appearing too rude, a bit more substance around this and a bit more where we're going, or how do we monitor that? What's their input? Yes, Colin, I think you were waving then.
Yeah, I mean, I agree, and I think it would be useful for Brunel to have a little bit of narrative on some of the issues and maybe some of the examples, because we'll not be alone as a pensions committee in getting questions from the public. And I think it's always very useful to be able to say, well, this is our engagement. In terms of, you know, what the engagement is about and what are the issues, I think the statement on ESG, and it's the G part, the governance bit particularly, is set out by Brunel in their, you know, their objectives. But actually, you know, some examples actually create a picture for us, which is actually really very useful.
Yeah, I agree. So can we do that, Matthew? Can we pursue that?
Absolutely.
Perhaps at the next meeting, which most of us won't be there, I suppose, but nevertheless, or not most of us, some of us might not be there. To correct myself, just to get that bit of a bit more substance around this, so we can understand really what we're talking about, and where Brunel is taking us on that route. Now then, Peter, I think you you had some points to make.
Yeah, I mean, the first thing that I was going to say is I prefer this. This is a much more accessible layout. I wanted to thank Matthew for doing that, and I would like to see it continue like this. Obviously, there are issues with the voting position, but to be fair, we've never seen that before at all. So the information we've got now is better than any information I've seen before. And I was going to comment on the voting positions. I mean, firstly, presumably, I'll say in that is that who the executives are on the Brunel board, and we'll direct them how they're supposed to take the voting rates. I mean, presumably we don't have an ethical, political, or opinion. I accept the point then, because I don't think necessarily our opinions reflect opinions of the people whose money it is what I would say. I think they would very much be in favour of remuneration discussions, remuneration and board structures. Although obviously necessarily know if you pay Rio Tinto 2020 makes you another £1 billion, or where he may do. I just wanted to ask Matthew about there was talk of a Brunel dashboard where a lot of this information would be accessible. I didn't know what happened with that.
Yeah, thank you very much, Peter. Yeah, we are still in development with Brunel on that, and I think it will be captured later on in certainly in the business plans and other areas where we're highlighting activity that Brunel will focus on over the next 12 months, and reporting and dashboards around this will actually take place. I think what I take away from this really from committee is, especially on this particular areas, that we need to enhance maybe the engagement and the understanding about the policies that Brunel have put in place, taking in feedback from all of the funds, and then how that gets enacted through the engagement plans. And I'll ensure that that's brought to committee so you can actually see the story as that goes through, and then the interaction that then Hermes do to apply that to the UN Sustainable Development Goals, and how that all links through. So Peter, that will be developed in the dashboard, and it will be, as I say, Colin, coming back in terms of that reporting, and we will continue to develop this alongside Brunel.
Okay, now then, are there any more questions? Because I'd rather like to move on. Any more questions for Matthew or for Julie? In which case we'll move on. Thank you very much. We do now move to item 7, the risk register. pages 25 to 40 in your papers. And Matthew, could you walk us through that one, please, quite briskly?
I will do. So risk register, thank you very much, is on the covering report 25-26 I'll focus on. You've got the full risk register below there. Again, any changes are shown in red and highlighted in yellow, hopefully for ease for those that are looking at that online. Fundamentally, I'll take them slightly out of order. In terms of no changes to the risks on the risk register, previously the resourcing risks were increased. Obviously, committee agreed to the additional resourcing in January. We are currently still in the process of recruiting towards that, so those risks will remain heightened at this time until we're significantly progressed with that recruitment, and that impacts on the resourcing from that side. In terms of decreasing risks, risks F1, F2 and F4, which related F1 and F2 to the actual strategy, again, is now being reduced back to previous levels on the outcome of the work that committee approved in January in terms of the equity strategy. And F4 relating to the deficit position of the fund, as we've just heard from Julie, the fund is in a solvent position, much to Ray's pleasure. On that one, so that risk has actually been reduced and mitigated down. The one that I will focus on is a potential increase on the risk of F6, which relates to pay and price inflation. This is something and an area where I've been in discussion with John, and I'll invite John to maybe make a comment on. I know John has been talking recently through the commentary in his reports over the last few quarters around some of the risks around inflation. Inflation exposure is one of the greatest risks that we face as a fund. Inflation affects the value of our liabilities, and therefore what can we, or maybe what are we doing or not doing in terms of that exposure on inflation risks. So there is a recommendation to increase risks F6 at this point, because we do think that we will enter a more inflationary environment as a result of coming out of the COVID pandemic. But also for us to undertake a review of how the fund can mitigate that inflation risk appropriately through its investment strategy and its risk management strategies. And for that review to be undertaken over the next few quarters and then brought back to committee with any recommendations that may be come out from that particular work. So, John, I don't know if you want to just add anything to that before we hand back to Ray. Thank you.
Yes, I think very quickly, my last few quarters have been noting the inflation, and part of the push to boost your property investment is as a real asset that has an element of long-term inflation linkage. The issue really here is that the COVID pandemic has been devastating from a health and financial point of view for many people, but actually the majority of us have got through it unscathed, and may well actually have been forced savers over the period, and certainly from national figures, we see the average saving rate has increased. There is a propensity to spend as we come out of this. That linked to high levels of government support. We saw yesterday's budget, the Chancellor extending the furlough scheme, extending business loans, etc. And linked to COVID destroying not just demand as we went through the lockdown, but also an element of supply. There will be some businesses that don't recover. So we are quite likely in the short term to have a rapidly increasing demand as we come out of lockdown and a slightly slower increase in supply. So it's possible that we see some element of inflation. If we look particularly at the US, the 1.9 trillion stimulus package currently going through the House of Representatives in the US is equivalent to 9% of GDP. That's as big as the collapse from COVID last year. And this isn't the first stimulus package, this is about the fourth. It's equivalent to giving every individual in the US $6,000. It is truly massive. If that hits at the same time as we come out of the pandemic, the economic lockdown eases, such as it's been in the US, the forecasts are for US GDP growth of 10 to 12% in the second half of next year. We've not seen that for 50 years. So there is likely to be a short-term boost in inflation. The bigger question and I think where Matthew's focus is perhaps directing us, is whether the sheer scale of monetary easing we've seen, of quantitative easing, and the printing of money by central banks is inflationary. And that's a multi-year thing. We've been through 40 years of declining inflation. Have we reached the nadir, and are we now in a long-term period of rising inflation? And that really comes down to central banks supporting higher inflation, supporting higher wage growth, particularly with minimum wages being pushed up. And all of that is gently inflationary. So we have a short-term issue of perhaps the next 12 to 18 months. But the question is that the start of a longer-term fundamental increase in inflation? And if that is the case, then it is something the fund needs to be positioned properly for and to have thought through.
Well, I think the difficulty is that we will be always behind the curve, won't we? We're never going to predict things correctly. I think that would be too hubristic to think that we're going to be smarter than the rest of the world. And of course, we see this, some of this through the prism of the funds which Brunel choose to put us in. So I think we have to be aware of these things, but it's very difficult for us to be nimble-footed in this approach. Thank you, John, for that. Have you finished that your presentation then, Matthew? If so, we'll move on.
Yeah, there was just the recommendation.
Oh, sorry, Peter Siegling. Peter.
The committee were happy that we undertake the review in reflect of the inflation.
Yeah. Sorry, but Peter's was signalling, and I didn't see him. Peter, over to you.
Yeah, just a couple of points. There's a couple of the risks that I was surprised that they've dropped so much. So F1 and F2 have dropped from 4 to 2. So what we're saying is that the risk to those investments is now almost as low as it can possibly be. Now, I'm just a person who can add 2 and 2 and not an economist at all. But after the worst economic shock in the history of capitalist society, that seems odd. Obviously, I'm cognizant of the shares have continued to rise despite the worst economic shock in the history of modern society, but it still seems quite a big drop in. I mean, sad that it's not quite noticeable, absolutely minimal. It's very low risk. It just seems strange to this circumstance. One I didn't understand. I think I understand. It was F6. There wasn't any change in the risk, but I assume just because you're recommending that we think changing it, because it shows that it's sort of going up, but I presume that means it might go up.
Okay, thank you, Peter. I think in terms of the risk of F1 and F2, it's returning it back to the previous levels where it was recorded previously. And I think ultimately that's in respect of the diversification of the portfolio in its entirety. Yes, we have a high exposure to equities, but as we become more spread, as John was saying, through property assets and more illiquid assets like private credit, infrastructure, some more of those real assets, and the diversification of the portfolio should ensure that the fund actually meets its anticipated rates of return rather than actually the market cycle. So, after the equity review, which has kind of brought that equity piece into focus, which was the larger part, which was the rationale for the increase, it's bringing it down to that pre-level on that particular side. But yeah, it's on that side. In terms of the risk on F6, yes, what I'm doing on there is actually that risk is increasing, the residual risk up to level 4, so it has increased from where it sat previously. At your last review back in December against the risk register, purely because of what we perceive and what John's just talked about, as a perception that we might be entering an inflationary environment, and the want to actually undertake a review of how we can best deal with that through the investment strategy in the fund. So I know I can see, Chair, I can see Colin waving. Chair.
Colin, yes, Colin.
Yeah, it's really, I was just trying to flick through the high inflation is picked up, if I've understood it correctly, and this might not be the case, is picked up in terms of the investment, but I don't see a risk, and please point it out, I probably missed it, on the outgoings. So as inflation goes up, pensions will go up. So, we've been looking at it from an investment side rather than the outgoing side, unless I've missed them.
No, absolutely. I think that's one of the biggest impacts and the biggest risks, actually, Colin, because obviously the pension benefits are set in regulation. We don't have a choice. So if we have higher inflation, that will increase the level of, especially now we're on a career average scheme that increases in line with inflation, and the pension pots increase, which then ultimately then increases the amount of the liabilities that we then need to cover with our assets. So ultimately the biggest risk to the fund when inflation hits is actually the push up on your liabilities and then the required cash flows for those liabilities that the assets then need to serve. So the only levers that we have as a fund is either increasing contributions or increasing investment returns or mitigating that inflation or that inflation risk as much as possible through your investment strategies. And that's what we will look to do as part of the review of how we can mitigate that, our biggest risk exposure as inflation as part of that review.
Yes. Sorry, yes, come back, Colin, yes.
So I suppose what I was trying to get at is that it's there, and I accept your point. I wonder whether it is, in a sense, a risk in itself. I may not be making myself that clear, really, but should it be a separate risk about pension inflation as opposed to just mitigating for inflation on the investment side? It's probably splitting hairs, and apologies for that, but it does seem to be something specific.
Take that point. What I'll do is, if I may, I'll take that away and look and make sure that that's covered properly in the risk register on that side, and refer that one back to you, Colin.
There is another aspect of these risks, of course, is the question for you, Julie, is what about longevity? We're now in the middle of a pandemic and everybody seems to be dying. How is this going to affect your actuarial view of these things?
So there's just kind of two schools of thought about what could happen with longevity, and it's a bit early to tell yet which way it's going to go. One is that, and probably the one you may expect, is that there's a shortened life expectancy because COVID continues to exist in society, shortening lives. Individuals with long COVID, for example, have a shorter than expected life. So there is the potential that it shortens life expectancy. However, there's also the other school of thought that says it could do the opposite, because we've got increased hand washing measures. People work at home more often now, so that's expected to continue to some extent. So there's less transmission of any disease. I know, for example, rates of flu this year are historically low. Tiny incidents of flu cases, whereas normally we would expect deaths through flus, in terms of the winter cycle every year. So it's not clear what the long-term impact of that will be. We do adjust your life expectancy assumptions at each valuation. So, and there's two parts to that. There's what life expectancy is expected to be right now, and there's what could happen in the future. So how we expect life expectancy to change. So that will all come under review next year. But I guess the summary answer is it's a bit early to see.
Yes, it's a actuarial response, that is it, on the one hand, on the other. So
Yeah,
we have to be a bit patient, I think. Thank
You
you,
do.
Julie.
Yep.
Thank you. If there's no more questions, can we move on to item 8, please, which is regulatory statements, pages 41 to 108, a massive amount of paper here. Matthew, can you guide us through this this maze, please, and perhaps rather more briefly than the hundreds of papers that there seem to be. Thank you, Matthew.
Yeah, I will do, Chair, on these two. And again, I will refer to Julie and John as we go through them. So the first one I'll look at is the funding strategy statement. This is one of the regulatory statements of the fund. It is normally revised with regard to the actuarial valuation. It outlines the way that the scheme operates with its employers and the funding of the pension scheme. There are some changes which are being proposed, are made to that funding strategy statement, mainly to introduce new employer discretions which have come through in regulation. They are highlighted within that funding strategy statement. The statement has been consulted on with all of the employers of the fund because it is material change. That consultation period ended yesterday. I didn't have any questions or comments from employers. Now, I would say that's not uncommon with regard to these, and especially in this situation, because we're not changing any of the assumptive basis or the funding basis. This is purely updating and introducing new discretions that the employers could potentially utilise. Predominantly, and the biggest one is around something called a deferred debt arrangement, which means that normally when a admitted body exits a fund or their last active member ceases, that will crystallise the benefit and it will go into cessation. And then we are talking about cessation payments that will then be due from employers during that time. What this allows is for an employer to actually cease to have active employees, but then continue to pay, especially if they're in a deficit position, continue to be evaluated as a normal employer, pay a secondary contribution rate up until a point that their secondary contributions have paid back the deficit, or as we have seen, the funding level changes to a point where they can then cease and not have a large payment on that side. So that's predominantly on the funding strategy. So Julie, I don't know if you've got anything else to add to that one.
No, I think that was a summary of the key points. Really, we've added in a bit more commentary around about the circumstances under which employers may request a review of contributions, so that the opportunity for doing that in the past was quite limited in line with the regulations. And as Matthew said, the options that are available to employers when they come to exit, quite often you can find employers in the tricky position of not being able to afford to stay in and equally not being able to afford to leave, which isn't a good position for the fund to be in, because you don't want an employer to be forced into continuing to gain liabilities if they ultimately can't afford to meet the cost of those liabilities. So there's more flexibility now in terms of coming to an arrangement with employers in that circumstance, or alternatively allowing them to spread any shortfall payment over a period of time. So there's new guidance has been released this week from the Scheme Advisory Board. Everything in your funding strategy statement is in line with that guidance, just to make it clear to employers what their options are and how the fund will liaise with them on those options.
Thank you, Julie. Matthew, do we circulate this to our employers so they're aware of all the regulations?
Absolutely,
right. Because this has happened, hasn't it? I mean, we have after all, the Cotswold Water Park is still with us, paying off its liability faithfully so far, and I think they're trying hard. But it's a long-term game, isn't it? We sometimes have to do these things which we prefer not to. So they do happen, and I think there are one or two others which I can remember where there was some misunderstanding of what the obligations of the employer were should his last employees be leaving. So these are important matters which we should make sure they understand, because often they don't. Colin, I think you were signalling.
Yeah, there's one question arises from that, which is on cessation. The actuaries look at how well it's funded and whether they're up to date. But it occurs to me that with different changes in legislation or court action, i.e. McLeod, that changes potentially the liabilities. Is it just tough luck that at cessation, if that hasn't cropped up yet, it's just too bad and it just reverts back to the fund? Or is there any kind of way of reassessing? And of course, it can go both ways with court decisions. So that's just a pure question. And then on the funding strategy, it's not wanting to appear like a broken record, but the more times that we can mention that it's certainly in terms of our investments, we, along with or through Brunel or whatever, take account of ESG for long-term investment stability. And I think this is our funding strategy, and to get a mention would be quite useful, because it doesn't just impose these public documents, and some people run through them and will question us at every opportunity. So I think the more times it's referenced in our documents, the better. Thanks.
Colin. Yeah, I think that's right. That was part one. Is that right, Matthew?
Yeah, that was part one. On the funding, and I think that it kind of works to what Colin was just saying, that the funding strategy statement is part of a suite of policy statements that the fund has to have. And I think thank you for the movement straight into the one that will capture around our ESG and our responsible investment risk, which is our fund investment strategy statement, which works alongside. But I do appreciate the linkage and maybe trying to bring that thread across both things, and we will look at that at the next revision on that side. And I think also to your other point, Colin, is that when yes, you do crystallise a cessation at that point, if there are retrospectives, unfortunately, yes, that will be something that ultimately the fund will come, and that there is that give or take. So it is a snapshot in time, but I'm sure that Julie makes the assumptions that we'll always make sure and try and build any known anticipations within there. It will be the known unknowns that are the problem that arrive in years to come. So on that point. So the second part of this paper relates to the investment strategy statement. And again, this is updating the fund's statutory documentation in response to the agreement that committee made in January in respect of the equity strategy. So the predominant change on the investment strategy statement document is the equity table and the exposures, and hopefully you'll pick up from there the reduction and the movement from the global passive and the increase in the allocation to the sustainable. The one thing that I will highlight to committee and before I get John to comment in, was actually a suggestion which came from committee last time, and a very welcome one, where we've actually, with the diversified returns fund, which we were using for the cash management, even though we have no strategic allocation to it, it is in the document and there is a range to allow us to actually operate. At the moment, that range works from 0 to 10%, and that is just a reflection of the volume of our movement into private markets during this period of time and the down weighting. I would anticipate that over the longer term, that target range will be reducing away from that 10% as we get more mature with our private markets investments into infrastructure, private debt, and private equity moving forward on there. So the update on the investment strategy statement reflects the recommendations which were agreed by committee in January on that side. So, John, I don't know if you want to add anything else to that.
I don't think there's much really to add. As Matthew says, that was as discussed in the January meeting. The actions to achieve that will take time. And I note that, you know, although we have it down as the strategic benchmark, it's not actually the one that the fund's being measured against at the current time. And because it will take 2 years to get there or so with the speed of drawdown into some of the alternative assets, we'll have to move the actual benchmark in steps as money gets drawn down, I suspect. So we're not going. It's not something we can do, unfortunately, in one jump, just because of the illiquid nature of the asset classes we're targeting: of private equity, private debt, infrastructure, property. They're all relatively illiquid. They all take time to invest in. So this is a sort of a 2-year move to achieve that benchmark, really, I suppose.
Okay.
I suppose the problem is that while we're moving into these, moving into our allocations, we're in cash, aren't we? We've got a huge amount of cash, 59 million or something. And it's sitting there getting, and people are threatening us with negative interest rates. So is there nothing we should be doing to park this money in somewhere fruitful while it's awaiting investment? Otherwise, we don't seem to be, you know, it's just hanging around waiting for something to happen, which is not something which I particularly feel comfortable with. I don't know about other members. John, you comment on that?
I'm happy enough to. I think in discussion with Brunel, I think, and Matthew will confirm this, the expected drawdown into the illiquid asset classes is about 30 million or so in the next few months. So a good proportion of it will go. Obviously, the commitment of 50 million to international property and 14 million to UK property is also being drawn down relatively quickly, and some of that's part of the 30 million that will be drawn down relatively soon. So I would assume that 50 million is used up by, really, I suspect much of it by the end of the second quarter. So we are now moving in, having been in a period when, if I'm honest, I felt Brunel just lagged slightly in getting some of the managers in place, particularly around private debt. We are now there. They are now beginning to draw down. So that money will be used quite quickly. The rest of the money, which in total you're talking about 200 million plus, the rest of that money was in equities. And at January, you agreed that we'd use that, the diversified return fund, which is why it has this 0 to 10% range in it. And that will be where much of the money while waiting drawdown will sit, because that fund should provide a less volatile asset class while still producing a positive return. So better than cash over the period that we're sitting holding it.
Okay. So are there any more questions for Matthew on item 8?
Yes. I think we just need committee to approve the recommendation.
David, I think you're waving, aren't you?
I just these are statutory documents. So where are they filed? Is there an authority we have to file them with, or is there do we have to display them in some way or put them on a website, or what?
Yeah, they will be, yes. So they will be, obviously, once they're approved by committee today, they will then be recirculated back to the employers again. They will be on the fund website, and they will replace the existing documents that are said there. So that will update. They're also included in the fund's annual report, as they need to be. So yeah, there are multiple parts. We don't need to file them anywhere centrally or like an equivalent to Companies House or central government, but it's about that publication. I think that's covered in my covering report about where that will actually be done as well. So yes, they will be public.
Okay. Any more questions for Matthew on this item? I think in that case we are asked to approve, which I suppose, Andy, means vote, does it? So all those in favour of approving the revisions and the funding statements and the investment statements produced in item 8. All those in favour, please show.
That's carried.
Any against?
Nope.
No. Any abstentions? No.
Nope.
Right, that's done. Move on. Item 9. You'll be getting a sore throat, Matthew. This is the training strategy which you're going to present to us.
Yeah, thank you very much, Ray, on this one. So again, covering report for committee on page 109 to 111. The full training strategy is there. The recommendation is that the training strategy for the Gloucestershire Pension Fund be approved by committee. The adoption of a clear training strategy is actually seen as best practice. The fund is committed to the SIP for Knowledge and Skills framework, and the strategy is there established as an aid for the Pensions Committee. It also covers the Pensions Board and officers as well, importantly, in allowing them to actually understand their respective responsibilities in relation to the operations of the fund. The strategy sets out those key roles within the fund and how we will go about maintaining the necessary knowledge and understanding to fulfill those roles. The strategy that you have in front of me, we've actually worked closely with Hymans to actually put that strategy together. So it is seen as it's being developed with them in respect of good practice and industry standard in terms of that. It's allowing us to commit to the SIP for Knowledge and Skills framework and how that will actually be delivered. Obviously, as Ray alluded to at the beginning of the meeting, this is quite timely for committee in terms of to take this item, because this strategy will then form the training plan and the training strategy for the committee and a new cycle of committee, which might include obviously new committee members potentially moving forward on that side. The one thing that I would say within the training, within the strategy, the actual applicable of training itself, a high-level training plan has been included within the business plan, which is on a separate later item there. What we will always aspire to achieve is actually for the training to be relevant and delivered in the most effective manner, but also to be in the most time-efficient manner for committee as well on that side. As I said, the strategy applies across committee, board and officers in its entirety. It will be taken back to the Pensions Board on Tuesday for their meeting, for their endorsement of the strategy as well. It also works around the good governance review that's being undertaken with the Scheme Advisory Board as well on that side. And it does feed into the overarching governance review that we're taking place up on that side. So this is seen as good practice for a fund to have a training strategy in place. It's been developed in combination with Hymans and the experience that Hymans have with regard to that. And I commit the training strategy to yourselves as a fund. And I can answer questions, and we've got Julie here as well, possibly.
Julie, have you got anything to add to what Matthew said?
No, just that it's really, it's a really positive step to have that formal plan in place, particularly in the timing with the potential new committee members. It is also in line with the requirements for the that have come out of the Good Governance Review, and we expect that the training requirements to be a bit broader than they've been in the past. So, yeah, just to echo Matthew's comments, it's a step in the right direction.
Thank you, Julie. Colin?
I think I mentioned this before, is that the initial training we got was good, but I'd asked the question whether there was any possibility we'd need to take this up with LGA or whoever really. That there's some refresher training, because once you've been in the committee for a while, you've got some experience, and then having some, formal training like that again, or a refresher, would be quite useful. And the other thing, which I found helpful on the one I went on, the initial one, was actually hearing from other people from other committees. And I think if our training is solely done, if you like, just in Gloucestershire, we don't benefit sometimes from listening to experiences from other committees. And I just wonder how we can pull that in. Some of the, if we go away to one of the conferences or something, then that's a good way of engaging with other people. But it would be, I think it's probably worth tweaking the strategy so that we can say that, you know, having that kind of outside view is helpful?
Yes, I think that's right. I think that you rapidly find out that you don't know everything once you start talking to a whole lot of other people, which is a good salutary thing to do. And I agree with what you've said. We all tend to lag behind. If we're not careful, we get too far behind. You can't catch up. So it's I think we're having a refresher there, and no doubt that will be built into your training program, Matthew. That there will not just be initial training, but refresher training to make sure everybody has the opportunity of catching up or as you say, refreshing what they've learned before if they need it. I think that must be the right thing. Peter.
Yeah, I just want to echo what you and Colin said, because I likewise did the some of the LGA training when I started, but it was 4 or 5 weeks, 4 or 5 years ago now. And apart from anything else, I presume some of it may have moved on as things have developed. The other thing is just a small thing that it's recommended that you look at the pension regulators toolkit. My only question about I did have a look at it when I first started on the committee, and bits of it are very good, but it's focused around private pensions committees. So for a staff representative on this committee, it's a bit confusing because staff representatives on private committees have more rights than staff representatives on this committee do. So that's just the thing, you know, should I have a number off somewhere, my replacement might find it a bit confusing. And the last thing, I did mention this at a Brunel meeting once. I just wonder if there's some benefit, training or otherwise, to organising maybe once a year a meeting of all the funds in the Brunel pool, the committee members, so we can talk through, try and pull best practice. I didn't necessarily seem a popular idea.
I think some people would think that's a great idea, but they'd be fine. There'd be others on the other side of the fence. But yes, I mean, there's nothing wrong for Matthew. You know all these participants now in the Brunel Fund, after all, and there's nothing to stop you asking, comparing notes with our colleagues, the other 9 colleagues, seeing what training they do, and whether we can learn from what they're doing. At the very least, we could do that, couldn't we?
I think absolutely. Just to if I may, just to come back on both Colin and Peter's points there. I think on page 123 of the actual strategy gives the approach, which does talk about external courses, conferences. I know Peter's alluded to the pensions regulatory program. You know, what we will be looking to do is deliver training in multiple different ways. The LGA fundamentals course is fully appropriate, because we will undertake training needs analysis with members on an ongoing basis. Refresher training and that aspect of it comes through. That's what the strategy is hopefully designed to do, is make sure that we don't kind of do training once and then that's it, and then we go on for the next 5 years without any refresher from that side. I think, yes, in the modern world, before we got to COVID, Brunel did used to run investor days, 3 of them, of which committee and board members were invited to attend alongside other pensions committee and board members from other funds. There's certainly some work that Brunel could do, but actually you're right. Myself as an officer and Sean in Oxford, we could actually combine ourselves at times to bring training together. Where I was previously at an authority, we did used to have a training day with another authority, a neighbouring authority, that brought both committees together to share those experiences. So, for me personally, I would advocate that, and it will be something that we will look to deliver to committee, hopefully on a face-to-face basis, because I would suspect that it would be a lot easier to undertake that on a face-to-face basis rather than trying to do it in a virtual environment that we are today.
Okay, fine. Yes, Peter, briefly, please.
Yeah, just there's this training opportunity. Would you like to take it? But the thing is, you don't know what you don't know. So
yeah,
it would be helpful for me somebody say, well, you know, you perhaps need to look at this a bit more because you haven't quite grasped how gilts relate to equities, or you know, something like that.
And
I think we did, perhaps a bit more formality might help too. So, okay, I think there's plenty to take away there, Matthew.
If the strategy is approved, Peter, that's what will happen, is that trading needs analysis, and it will be coincided with the advert of the new committee going forward. So, yeah, you know, go back to page 111, Ray, and whether or not the committee approved the trading strategy.
Right, now then, we asked to approve it. Those in favour of approving, please show. Those against? Those abstaining? Is that all right, Andy?
Lovely, thank you. I'll note it as approved.
We're now going on to item 10, and after item 10, I'm going to propose a short comfort break. So I hope it's not going to take too long for my sake, but there we are. You must take as long as you need, Matthew. Matthew, over to you on the business plan, which is on pages 131 to 150. Thank you. Over to you, Matthew.
Okay, thank you very much. And yeah, I'll kind of rattle through to get through on the business plan. So the business plan for 2021-22 is attached at Appendix 1. The proposed business plan. But before we look at that, I think it's also appropriate to look at the outturn of the business plan for 2020-2021, which actually only came to committee in September. So it's fairly short order that you're actually looking at that. On the page 132 was the agreed work plan for 2020-2021, which predominantly focused around items to come through from committee. And what I've done is advocate and go through what that agreed work plan was and apply ticks and crosses, obviously, to those that have been done. Certainly, there's one or two areas where the crosses, the majority of them relate to presentations from Brunel, which we didn't have during that particular time. Administrative update, but we dealt with administrative issues at the additional meeting in January, and obviously we had administrative update this time at this meeting. The only other one predominantly was the policy statements, the governance policy and compliance statement. And that, what I've done is allowed that to roll into the work plan for 21-22 as part of the governance review that Aon will be doing. They'll be reviewing those documentations and coming back, you know, either to say that they're fit for purpose and working, or that we will make some additions and amendments that will be required from that side. In terms, so on page 135, what we've done is pull together the agreed budget from last year, put to the budget expenditure to year to date to the end of December, a forecast outturn, and then a potential variance on that particular budget. We redesigned the budget that was agreed to actually replicate what is contained in the annual report and accounts for committee. And the new budget has been created on the same basis. And the idea will be is that budget will come back to committee on an ongoing basis, so you can monitor that budgetary expenditure and the business plan ongoing, you know, as part of good governance moving forward. If we look at the budget outturn, the majority of the underspend relates to vacancies and staffing vacancies that have been there during the year with regard to that. And one of the major overspends relates to the investment management fees. Now, these are the fees that are charged by the portfolios. And as we have talked about earlier, where we have seen a market increase in the value of the investments that we have, that ultimately has an effect on the amount of fees because of the way that the fee basis works as a basis points of the assets under management. So as the assets under management grow, then obviously the fees do as well. So it's not always a bad story when you are seeing an increase in the value of the fees, because commensurately you're seeing the increase in the value of your assets during that period of time as well on that side. What we have done is extract the Brunel contract costs. And as you can see, that was on target with the agreed budget from last year. So that's not captured in that management fee perspective. That's just really the ongoing management fees from that side. So the outturn obviously is an increase on that budgetary exposure, but the main driver has been those increases in the fees on that side of it. Looking forward to priorities for 2021-22, focusing on 4 key areas moving forward. That is to the completion of the transition to the Brunel portfolios, with the fixed interest portfolios now due in the next quarter. The implementation of the strategic asset allocation that we've talked about, and the review undertaking around the fund's exposure to inflation risk, undertaking the governance review, and also reacting to the Scheme Advisory Board's guidance that will come out through the Good Governance Review, and then the progress with regard to the recruitment plan that was agreed by committee in January. Obviously, these things sometimes take a little bit of time to actually get people in situ on that side. There are other areas that we've discussed already, the 95k cap, that are going to come back and actually, we will deal with that and the McLeod implications as we go through. So obviously the primary objectives remain the same for the fund moving forward, around achieving that 100% funding level, ensuring that we're got adequate cash reserves to fund the liabilities and the commitments that the fund has made, and that the fund is actually being administered in accordance with the regulations moving forward on there. The associated budget that is contained for the year is an increase on the budget forecast from the 9.7 to 12.5. The majority of that increase, it relates to the expected increase in the investment managers' costs on that side of things. And obviously there's a slight increase in the resourcing cost that was agreed by committee in January that has been built through on that side. So on that side, Chair, I will allow yourself to take any questions on the budget.
Okay, any questions for Matthew? Lyndon.
Thank you. Just on page 146, on that investment management fees increase, I mean, I understand the one, part of that relates to the increase in the fund, but that is still a significant increase. What I would appreciate is if you could give us a bit more of a detailed breakdown on particularly the increase. Now, I know you mentioned it's around, we've changed some of the asset classes which can, incur higher levels of expenditure. So I think what I'd like to see is a schedule that breaks that down so that we can see what the impact has been of the decisions we've made to get to that 8 million, isn't it? Would that be okay, Matthew?
Yes, absolutely. If you will leave that with me, I will go away and do that analysis, and we'll bring that back to you.
Okay.
Circulate to all members of the committee, please, Matthew.
Absolutely.
Okay. Any more questions for Matthew on this subject? No? Then we need to approve this. So those in favour, please show. Those against? Those abstaining? Then that's agreed. Thank you, Matthew. Members, I'm now suggesting 10-minute break before I burst. I don't know about the rest of you. That so we be back here at about 10 minutes. It's about, according to me, about 20 to 12.
Ray, I'm ever so sorry. Could we just quickly read item 11 and then we could adjourn then? That way then I can end the live feed and then it would be easier. If you don't mind, read quickly.
This is to go into private session. Is that right?
It is.
That means that members of the public can leave. I think.
Yes, please.
Yeah. So the exclusion of the press and public. Item 11. It's resolved that in accordance with Section 100A(4) of the Local Government Act 72, the public be excluded from the meeting for the following agenda items because it is likely that if members of the public were present, there would be disclosure to them of exempt information as defined in paragraph 3 of Part 1, Schedule 12A of the Act, and the public interest in withholding information outweighs the public interest in disclosing the information to the public. do we have to take a vote, Andy?
If I can just ask, do you all agree as the committee?
Anybody? Okay, I think we're all agree. Thank you, members.
Thank you very much.
So 10 minutes time, please. Thank you.